So interest rates for mortgages just hit the 7% mark again. What exactly does that mean for the San Diego real estate market? Well, we're going to get into exactly what that means, how that will affect you as a buyer or a seller, and what's causing this and what to expect going forward. So let's get into it. Howdy, howdy, Chris Erickson here with the Beach Life Group here in San Diego. And if you guys are ever thinking about making a move, hit us up. All the information is right below. We got your back when making the move here in San Diego. So as of yesterday, mortgage rates did tip over that 7% range again. So what does that mean for the San Diego real estate market? Well, since this did happen last year, I'm going to tell you what happened back then so you can equate it to see if it's potentially going to happen right now. This is right around the same time last year when mortgage rates did come off that 3% level and did start rising and did make a change in the real estate market as we went up into that 6% range compared to 2022. Just to give you an idea as a whole, the market for buyers was very competitive. Sellers, everything was selling on the market. Everything was going for well above list price. Everything was going in that first weekend. And I'm saying pretty much everything. Didn't really matter condition, location. There was so much demand out there. This really started to kind of diminish a little bit of the demand as interest rates did rise. So once it did pop above 6%, it did start falling down a little bit. And then boom, shot right back up. Right when we got into September of last year is when it crossed over that 7%, peaking up at about 7.37% in October. You can see it stayed there elevated there for a little bit. We did have a little blip over here back in March where it did go over a little bit. So what happened during this time and what's going to happen during this time when it just did cross 7% right now? So here's a chart from the last 5 years. You can see all this information too, it is all seasonal. So we do have some seasonality in the market when things kind of in that spring market, they do ramp up. Days on market are a little quicker. So during this time, we are kind of in the downturn of the season anyways, not right now, but last year when it went over 7%. But you could see it was much more dramatic than in past years. Coming into where we did start seeing a little bit of the interest rate rises, you could see the average days on market before they started going off of that 3% range in May. Days on market average days were 11. Then the mortgage rate started creeping up compared to that last chart. And you could see right around this time when it did hit that 7% range. And like I said, some of that seasonal, usually towards the end of the year, days on market is going to go up a little bit anyways. But you can see it's much more dramatic last year. So that's the first thing. Days on market did go up. Last time we did hit 7%. The second thing that did happen, there was less competition in the market. So the percent that people were getting for their homes went down. You could see it peaked out last year in April of 2022 when the rates were still relatively low at 106.3%, meaning if you're selling $1 million house, you were getting $1,063,000 on average. A lot of times if it was dialed in, if it was ready to go, that number was a lot higher than we're seeing right here. You can see as rates did go up, it dropped significantly down to 96.7%. So that same $1 million house, you were getting $967,000 for that home. So we weren't at that 100% of list price anymore. A lot of it being a lot of buyers did drop out. Once again, the end of the year, November, December are typically a little bit slower. So that does have an effect on it. But you could see it did have a huge swing. And then coming into this year, now we're sitting right about 100%. And the third thing that happened was prices did fall. You could see it trended up. This is all when all the craziness happened. Same thing. All these charts are telling the same story. The prices did peak out at $865,000 in May. Interest rates did go up. Prices did drop quite a bit, coming down all the way to $750,000 in December. You can see we have trended back up, but we were still under what it was last year. So those are three things that happened last time we did hit 7%. And just because this says 7.01% does not necessarily mean that is what your mortgage rate is going to be. Definitely talk to your lender. Every situation is going to be different depending on your credit, depending on how much money you're putting down, depending on what loan program you are going into. And before we get into point two, I want to know what you guys saw during the last time interest rates got into that 7%. Drop it below. I want to hear what you guys are thinking. And even though it did touch 7% a little bit earlier this year, it was only for a very short amount of time, whereas the last time it was for a few months where it did stay in that 7% range. So the duration that it does stay up there will affect the market more and more. There's some sort of psychological level where buyers totally dropped out of the market when it hit 7%. We got a little more comfortable this year, coming in the 6 to 7% range, like 6.5 is what we've seen over the past few months. But once it hit that 7%, we heard crickets out there. A lot of buyers were sitting on the sidelines waiting to see what happened. So Is 7% a psychological barrier where buyers are not in the market and they just want to sit it out and see what happens? Potentially. That's what we did see last year when it did go over 7% for that extended amount of time. So if you are a seller out there, you're thinking about selling your house, you can expect less demand out there, less multiple offers, less buyers as a whole. So in turn, the final price you do get for your home could be a little less than what you expected maybe a few months ago. And as a buyer, it could be an opportunity. If you are willing to purchase a home and you are comfortable at that 7% range, there's going to be less people out there, less competition. So you are going to be at an advantage. So what does that actually look like if you are out in the market looking to purchase a home, a 6 versus a 7%? Well, check this out. We have it super simple. We're putting an $800,000 loan amount, meaning let's say it's $1 million house. You're putting that traditional 20% down. This is only including the monthly payment and interest. We're not including in here taxes, insurance, HOA, all that kind of stuff. We're just keeping it simple. So $800,000 loan amount at 6% is going to cost you $4,796. So what happens when you put it at 7%? You can see the monthly payment jumps by about $500. So you're looking at about $6,000 for the year between a 6% and a 7% interest rate. So what's causing rates to be so high right now? I think the number one thing is uncertainty. One thing that is causing this uncertainty is what is the Fed doing? While what the Fed does doesn't necessarily dictate what happens to the mortgage rate. So, sometimes during this past few months when they have raised the Fed funds rate, the mortgage rates have actually gone down a little bit. Usually it's a better indication of the 10-year treasury, what's going to happen to mortgage rates, and that has been going up. But either way, the Fed raising rates does have some effect, even though it's not correlated perfectly. And the uncertainty right now is, are they going to continue to raise? Are they going to pause? Or are they going to cut rates? So that 10-year treasury is usually a good indicator, like I mentioned, of what's going to happen with mortgage rates. If that's going up, mortgage rates are going to go up. But the spread, the difference between what mortgage rates are, 7%, and where the 10-year treasury is usually about 1.8 or so, the difference. Right now we're sitting above 300 basis points or 3% difference. So a lot of that is because of uncertainty in the market right now. Second thing causing uncertainty is the debt ceiling. You've seen it all over the news. What's the government going to do with the debt ceiling? Are they going to raise it? Are we going to default? So they're going back and forth figuring out how to best go forward with the debt ceiling. Is the US going to default? Probably not. But when are they going to come to an agreement and figure out what is going to happen with the US debt? And the third thing, which you've probably seen on the news, is potential recession. What's going to happen with that? While home prices and interest rates and all that don't necessarily go down in a recession, there is potentially job loss. There's potentially uncertainty in the market. There is potentially stock market fluctuations. All that combined just adds to more uncertainty in the market. So a lot of what happens in the San Diego market at that 7% interest rate really depends on the duration, how long it is like this. Are we going to stay for an extended amount of time like we did last year? Or is it just going to be quick? All this uncertainty is going to get flushed out of the market and then interest rates will kind of moderate a little bit. We shall see. Be sure to tune in every week right here to find out what's going on in the San Diego real estate market.